At age 19, a young man read a book that changed his life forever, providing the emerald green light of knowledge used to build $100 billion empire. The textbook tells you that the intelligent investor is the definitive guide to future wealth. But in the real world, I have seen 9 times out of 10 that people treat it like a trophy on a shelf rather than a battle manual. True investing is defined as buying partial ownership in a real business, while speculating is merely buying letters on a screen. The golden rule is simple. If you wouldn't buy the whole business, don't buy a tiny piece of it. My specialist opinion is that most traders fail because they approach the market like a casino, ignoring the fact that real wealth building is highly profitable but mostly boring. You have to deal with your neighbor, Mr. Market, who is emotional, dramatic, and manic-depressive. The textbook says his mood swings create your opportunities, but in the real world, I've seen that people let his panic instruct them instead of letting him serve them. You must learn to ignore the price tag, which is just what Mr. Market asks you to pay today, and find the intrinsic value, which is what the business is actually worth underneath. To protect yourself, you must use a margin of safety, much like a bridge designed for 10,000 pounds that only carries a 2,000-pound truck. This rule means you never pay full price and always leave room for realities, mistakes, and unpredictable storms. In the real world, I see investors redlining their risk while ignoring the invisible predator of inflation, which guarantees a loss of purchasing power over time if you just save cash. You must choose one lane: the defensive investor who uses broad index funds with 1 hour of effort per year, or the enterprising investor who treats undervalued businesses like a part-time job. The textbook warns about the middle ground, but in my experience, that is where portfolios go to die, because people want active returns while only putting in passive effort. To survive, you need diversification as a shield against the unknown, because we cannot predict the future, and you should never marry a single stock. Before buying, every company must pass through the Buffett filter: the business gate, the management gate, the financial gate, and the market gate. If a company fails even one gate, you must walk away. Your ultimate weapon isn't a secret algorithm, it is emotional discipline, because your job isn't to control the stock market, but to control yourself when the world loses its mind. You can put your emotions on autopilot through dollar cost averaging, buying mechanically whether the market is high or low. Wealth is quiet and requires staying rational to let the system work for you. The real reward for patience is compounding, which is like a snowball rolling down a hill where time does the heavy lifting. In the real world, 9 times out of 10 people quit too early, forgetting that over 90% of Warren Buffett's wealth was generated after his 6th birthday. If you want more specialist takes that go beyond the textbook to help you build real wealth, make sure to hit the subscribe button and join our community of intelligent investors.